All right, Louis, let's talk a little bit more about where we think this is going. I mean, it looks as though the markets have lost faith in the central bankers, perhaps even around the world. They just seem to be in a selling mode. What do we do with that information? I wonder, is Fed Chair Jerome Powell going to continue with his path? I mean, he sounded adamant that he's absolutely going to continue to raise rates. I don't even know if doing that is going to combat inflation, other than you'll have, significant demand destruction and a very hard landing, which is what the market seems to be pricing in. Or will they backtrack like they've done since 2008?
Uh, it's a tough one, but look, the easy part is yes, the markets are losing faith in central bankers. That part is obvious, and yes, we are in the midst of a liquidity crisis, and liquidity crisis end either when central banks add back liquidity or energy prices collapse. Those are the markers you have to be looking for. So indeed, I think the questions for the coming months is which comes first, and I would tend to think that it will be the Fed folding first. And in that respect, maybe the current setup isn't that different from 2018. In 2018, the Fed was adamant that it would keep rising. The Fed was adamant that it would keep tightening, and as equity markets collapsed, it changed its tune. The difference this time, the big difference, there's two big differences this time. The first, of course, is that back then we didn't have an inflation problem. Today we do. The second big difference is that this time around, the collapse on the bond markets is starting to be really epic. And this collapse in the bond market, to me, is really the linchpin, because the big question mark is, what does that mean for government funding going forward? In 2018, the U.S. government had roughly 20 trillion in debt. Today, it has 31 trillion in debt. 31 trillion in debt to roll over, and the maturity of this debt has been shortened considerably. So when you look at the massive sell-off we're seeing in 2-year treasuries, we're now, it's like, it seems that they've been going up like 15, 20. The yields have been going up 15, 20 basis points a day. Is that because of this perception that the Fed is going to be massively hawkish, or is it because of the fact that the U.S. government is going to start having problem rolling its debt over? And if it does, can the Fed sit back and do nothing? That to me, I think, will be the big question for 2023, whether not the breakdown in the equity markets, but the breakdown in the bond markets end up forcing the Fed's hand. And the answer is, I think it will.
Because of all the incredible ripple effects and implications for pension funds, insurance companies, banks, let alone the U.S. government. I mean, that's
That's exactly
people.
that's exactly
Yeah,
right.
people forget how large the fixed income market is. I don't even have the numbers at the top of my hand, but I should. Fixed income versus equities, there's no comparison.
Yeah, no, it's absolutely massive, and I think indeed, to your point, that's also the big difference between today's sell-off and the 2008 sell-off. In 2008, people lost money on equities but made it back on bonds. Today, they're losing. If you're a pension fund, a 60-40 portfolio, an endowment, you're losing money on both sides of that equation. So much so that the capital destruction this time around is actually greater than it was in 2008. In 2008, the capital destruction was around $10 trillion. We're already at over 15 trillion just for the US markets. We're already over 15 trillion of capital destruction because, again, it's the bonds plus the equities. And yes, to
In
your
what
point,
time period, Louis? That I didn't know that. 15 trillion of destruction
oh, just year to
already,
date.
and more than the fund.
Yeah, just
Wow.
year to date. Yeah, that's more than
Okay.
2008. So, and so indeed, to your point, who's on the other side of that capital destruction? A lot of that is pension funds. Your state pension funds, your municipal pension funds. Remember, they came into this crisis already underfunded. Um,
Yeah.
they were all underfunded, and now all of a sudden you lose 20-25% on your bonds, you lose 20-25% on your equities. You haven't even begun. You lose whatever you've put abroad. You lose because the U.S. dollar has been shooting up, and you haven't begun to realize your losses on the VC and the private equity. That's still to come. So
Right.
no, the big story for 2023, I think, will be the underfunding of U.S. pension funds and the underfunding of uh, municipal funds, etc. And yes, against that backdrop, can the Fed keep tightening? I think it'll end up forcing the Fed's hand.